So I couldn't do one without talking a little bit about this. Where does money come from? I mean, remember we talked about the bloodhound? Or the retriever, the first dog to get the company started. And they got to trade stock for ideas, capital, and talent. Well, let's talk about how they trade stock for capital. These are the sort of different sources of capital. And it's a lot of fun in our classes to dive down and talk about the pros and cons of each one of these. And you'll hear that a lot in here as well. I mean, for example, there's angel investors, which is just wealthy investors, individuals. There's corporate venture capital, which is something like Intel. There's the traditional VC, like the Sequoias and Excels and Kleiner Perkins. And then there's bootstrapping, which is either personal funds or convincing a customer to pay you some funds up front. So, and then there's other, what do you think other is for a moment? What's the public, right? So if a company ever gets really, really successful, they can go public, and that becomes an investor. Right, and for growing the company. And what got really weird 5 years ago is the public was really interested in getting involved super early on, where there was tons of risk, until everything kind of unraveled. So, there's pros and cons to each one. We could sit here for another half an hour and talk about that, and it's really a lot of fun to do that. Say traditional VC, what's the pro? Well, they got lots of money to deploy. And for people who are really going to go for something and really change the world, they got lots of money to deploy, and they got lots of expertise to bring to the table and help. And you'll hear that over and over here and again. But what's the downside of VC? It's really expensive money. I mean, in terms of the dilution and the ownership that's going to have to be given up in order to have them involved. And we can do that across the board. So the other thing, do I have this? No, I don't. The other one I want to mention here is over and over we see the following, and it's really fun to do this when we're teaching this material. It is a process. All this stuff is a process and a set of mechanisms. This notion of venture capitalists and entrepreneurs getting together and cutting a deal, like it's some sort of television show or something like that, is really way offline. Getting the best price like it's a used car. What really goes on, and over again, it's not the best price that gets the deal done. There's been academic research on this, and there's been, just layman research done on this that shows that rarely does an entrepreneur take the best price from a venture capitalist, meaning, they get the most money for the least amount of ownership given up. It's all the other stuff, all the other terms and conditions that come into play about how they're going to help each other be successful.